All right, good morning, everybody. People are joining in here for a second, but let's get rolling. So, what a month it's been in all kinds of financial markets. Housing is no exception. There's a lot underway. There's a lot of really fascinating changing data happening right now in the housing market. We're going to hit all of that today. There's some real big differences in some of the local markets. So, we're going to talk about those today. Lots to get to. The things that I'm thinking about right now, it's April. We're approaching the peak of the housing market, buyer and seller transaction time, peak of home prices. But of course, we've got a lot of headlines. We have a little bit of insight about how tariffs hit the housing market. Of course, one of the challenges on the tariff policies is we don't actually know what's going to be implemented and when. There are new announcements and changes every day, but we're going to see what we can see so far and how to help people make decisions in the face of this uncertainty. And one of the things about the uncertainty, of course, is that uncertainty creates fear. Fear tends to lead to inaction, and the data is the antidote to fear. And so we're going to try to talk through the data so that you can be prepared to communicate with people who need to understand what's happening in the housing market right now. And the national headlines may be very different from a lot of the local markets. So we're going to try to spend some time with some of the local markets today in a way that we maybe haven't done so in previous webinars. Stay tuned for the second half of the webinar. We can dive into that. Home sales are up in April. The NAR numbers just came out. The existing home sales numbers for March came out a little under. So the headlines for March, our home sales are down year over year. And I'll show you in a sec, but they're up for April. So when NAR announces next month, the April numbers, they should be up. The question is, can that hold up? There are in the face of rising interest rates and a deteriorating economy. So we'll look at home sales and the weekly pending home sales, the Altos weekly pending home sales. We're going to look at the latest with home prices and how those are changing across the country. And then, as I mentioned, the local markets, some local markets are changing much more quickly than others, and some are very strong, and some have some weakness both in sales volumes and in prices. So those are the top questions that are worth watching in the second quarter here of 2025. And we are approaching peak season. Before I dive into the data, if you are new to Altos Research, all the data I talk about today, you can get in your Altos account. So, and you can go get a free account now. You go to the altosresearch.com and just enter your zip code you get a free report. It's the entry level account. You can get that for any zip code in the country. We're talking a lot of national data today, but also some local and metro data. But if you want to start diving into your zip code or like communicate with potential buyers and sellers, that's what you use the Altos product for. So go to altosresearch.com and you can get started and dive into the data. You can talk to our team about your local market and we can dive into. I can't get to all the local markets today, so I encourage you to do that, especially if you're new to Altos Research. Okay, let's hit some data. Let's start with mortgage rates and what happened after the tariff announcements this month. So April 2nd, the tariff announcements kicked in, and they were big announcements. And two things happened. One is that the 10-year Treasury, the interest rate jumped, and it jumped probably for a lot of reasons. That's the bond market. It has infinite reasons. But one of the things that is most important to housing is that when we are importing goods and we're sending dollars overseas, buying stuff, those dollars come back to the US very often in investment, especially in buying US debt, treasuries, and mortgage-backed securities. And if we are in a world where we are sending fewer dollars overseas, one of the impacts is that there is less demand for US debt And so interest rates rise. And that's what happened very quickly after the tariff announcements at the beginning of the month. So mortgage rates had been easing down. We could see the impact in March and early April, easing down, getting to the lowest point of the year the a day after the tariff announcements, and then promptly spiking back up over 7%. And then I've bounced around in here around 7%. They ticked down a little bit today, but mortgage rates are around 7%, a little under still right now, still at the highest point in a couple of months. And two things happen, right? So there's the underlying 10-year treasury, which has less demand. There's also the spread between the 10-year and the 30-year fixed mortgage. So mortgages are a little riskier and therefore have a higher interest rate. And that spread increases in chaotic market environments. So the tariff announcements both drove up the 10-year yield and drove up the spread. So mortgage rates have a double whammy. I've described it. I wrote an article last week for HousingWire that had the headline, "More tariffs are creating a perfect storm for housing." So beyond the mortgage rate and the spread, the 10-year yield and the spread driving mortgage rates up, we're also then facing an economy if we have if the tariffs, assume the tariffs in some capacity go through, those also slow down the economy, drive up unemployment. And so we have a potential environment in the second half of the year where the economy is slowed, incomes fall, unemployment rises, and interest rates are higher. So that would be the perfect storm. Now, it's early in this process, and there's so much uncertainty about the tariffs that we don't actually know. As of right now, the hard data, meaning the number of homes that we can measure, home sales versus last year, are up. They're up a fraction in April. They were down January and February through about halfway through March, and then they started ticking higher. And I'll show you that in a second. And the question is, can they stay up in that environment? So the first thing to know, though, is we're now back in a 7% mortgage environment, and that is probably a risk. However, last year at this time, mortgage rates went over 7% to like 7.5%. And home prices are roughly the same nationally. And what I've done here is highlighted typical mortgage payments. So looking at, for example, an 8% down on a $390,000 home, typical mortgage payment. So mortgage payments, so the purple line here for 2025, they're actually cheaper than they were last year at this time. And so that's one reason that home sales are a little bit higher than they were last year. So last year at this time, home sales were really slowing down because rates jumped over 7%. You can see late last year as as payments dropped. So mortgage rates were dropping in August and September, hit their low point in September. They were the typical payment was significantly more affordable late last year than it was the year before. And as a result, in that moment, that time last year, home sales picked up a little bit, home prices picked up a little bit in the second half of the year. And you can really see it driven by this mortgage payment. We have a new variable this year, which is even if payments ease down, and let's say we get lucky and the bond markets and mortgage rates ease down in the second half of the year, even if those tick down, we are suddenly facing a much less certain economic environment, much more fears about employment. And if people are worried about jobs, they are less likely to buy homes. So that's a variable. That fear, that economic fear, recession fear, has not really existed for like 15 years in this country. So it's really been an interest rate only question. So when we look at the macroeconomic data for the rest of the year, rising unemployment rate, for example, slowing economy is a real factor that we haven't had to deal with in a long time. However, my colleague Logan Mohtashami points out that even if unemployment kicks up later this year, we still have a lot of employed people in the country. And Logan's hypothesis is that even if if unemployment rises, we still have enough people employed that housing may actually uh, be supported in a weak economy later this year. I think that's a valid thing to a valid hypothesis to keep in mind. It's not all negative. We know that the American homeowner has very strong financial position, especially with their 30-year fixed mortgage. Their existing equity is very high. So all of those things are actually bullish on housing, but they're fighting the broader macro environments, which are the early data on that, the survey data, the soft numbers are coming in very low, like very weak. The hard data, like the actual home sales each week and unemployment numbers, those are still actually, and things like corporate profits are still actually very good. So the hard data hasn't turned south yet, even though some of the survey data is like really slow. So that's where we are in the macro sense right now. Um, it's actually more affordable right now than a year ago to buy a house in the US. Rates are lower than they were a year ago. And if we're lucky, then rates tick down, and that continues to be the trend through the peak buying months here, April, May, June, into July. If we're lucky, that's what happens with mortgage rates, and that drives things further along. Okay. Um, Next step here is so I mentioned that home sales are up over last year. So this is the Altos weekly pending home sales. So these are the homes going into contract each week, and you can see 2025. We started the year with fewer home sales than 24. And as I mentioned, NAR just announced the March numbers and announced that March home sales by NAR's estimate were lower than a year ago. And you can see that in the weekly pending numbers. They turned positive at the end of March, and through April, sales have been greater than the year prior. So 72,000 single family homes went into contract this week, just a little bit, 71,000 last year, so just a little bit more. And then the question is, what happens for the next few months? We have rates were highest last year at this time. So we have a year over year comparison. And that means that these May, June numbers were really low for last year. We'll have the next week's Altos data will include the Easter holiday from the weekend. And so there'll be a little dip here, and then we'll see if we recover above, to 80,000 or so sales at the end of May and into June. That would be very encouraging. But if we see the opposite things happen, if we see people continue to be afraid about the economy, to continue to be facing things like government cuts, to continue to be worried about tariffs, then those may pull the other direction. So the question right now is, we're going to have April home sales come in higher than a year ago. And the question is, can it continue? There's a lot of variables. And so we're just watching the weekly pending home sales every week to see if that can keep up. Um, Let's go to, so then if we look, so that was the weekly pending. And now if we look at all the homes in contract, so there are 350,000 or so single family homes in contract right now. So you can see the 25 line is now above the 24 line just a little bit each week. It moved over in April, as I mentioned. So the headlines will be very clear, small gains in home sales for April. And then we're going to watch what happens in May. So as of right now, there are 391,000 single family homes in contract. That's up nicely for the week. There'll be a dip they'll be flat for the Easter holiday. Easter's later this year. So last year, Easter was at the end of March here. So you had this dip before we drive higher. So we'll have a little bit of holiday things that kick in there. But as of right now, home sales are just a little bit ahead of last year. Okay, let's switch to the supply side. There are now 719,000 single family homes in on the market, unsold on the market. That's 32.5% greater than last year nationally. I'm going to show you which states are more, but in the long-term trend here, this is 10 years of inventory trends. You can see the pattern here at the last decade. Each year was generally fewer homes for sale between 2018 and 2019. 2018 was a year of rising mortgage rates. And incidentally, that was the year of the last Trump tariffs. And so it drove interest rates higher that year and the economy slowed. So as rates rose, inventory rose between 2018 and 2019. So we still have slightly fewer homes on the market than we did in 2018. So at that time was 813,000. We're at 791 right now. So we are almost past this era of the pandemic crisis shortage of homes for sale. By the end of the year, we should be back to the old normal levels of homes for sale. That is now not evenly dispersed across the country. The rising inventory, so this is unsold homes on the market. So the way I describe this is like the supply of homes, if you think about it like a reservoir, the reservoir has been generally filling for 3 years. Mortgage rates have been rising, demand slows, and inventory rises. So the reservoir has been filling back to the old normals from the very low drought during the pandemic. There is also how hard is it raining? So this is the inventory is how full is the reservoir, but on the new listing side is how hard is it raining? And what we've known is that you can see here in the new listings volume, the last few years, like last year, 70,000 new listings each week. And now we're getting back to the old normal levels of new listings each week. So this is sellers each week. So now it's 77,000. So the gray lines here are the last year, the previous years. And the blue line is last year. The gray lines at the bottom are the pandemic years, the last 5 years, and the gray lines at the top are before that. So we're getting back to the old normal. So it's finally starting to rain. And by the way, I think I forgot to mention at the beginning, along the way here, we like to use the chat. There are Rita, Jeff, and Amanda from the Altos team that are in the chat, and so you should be looking at the chat and like looking for links and stuff, answering questions. Drop your questions in there as we go along. Okay, so what I'm watching for in the new listings is do the new listings get up here above the old normal levels? 70, so we're at 77,000. But there might be years where there's 100,000 new listings in a week, 90 or 100,000 on single family homes. And so right now we're getting close to old normal, but we're not above the old normal. Above the old normal levels would imply some amount of like panicky sellers. Maybe it's people who are losing jobs who need to capture the cash equity in their home. There are lots of those would be like negative scenarios. And if inventory is rising, the reservoir is rising, and it's raining really hard, those would be a much more bearish signal for the housing market, for future sales prices. And so what I'm watching for is, do we have the home? Do we have that level of sellers? My suspicion is that because home owners have really good equity. They have excellent mortgage rates. People who refinanced in 2021 at the lows are already past the tipping point of their mortgage where their payments go more to principal than to interest, which means that their equity is increasing every month, even if home prices are flat or even down. So most homeowners in this country are in a very strong financial position. As a result, they don't have to sell, even if they lose their job or they're afraid of their job. That what they want to hold on to is the house and the mortgage. So my suspicion is that we don't see the purple line climb above the gray lines later in the year, even if we see like a real slowdown in the economy. But that's what we want to watch for each week. As of right now, this level of home sellers, I would call healthy for most of the country. There are still some of the markets which are under supplied, and I'll show you those in a minute. The takeaway on new listings is that it's up nationally, but it's not too high. And so we're going to watch to see if that maybe changes. On the supply side, so I've been talking about how some parts of the country have different levels of inventory than the previous year. So the darker purple is the more inventory change over the last year. So you can see across the West, 52%, 54% in Nevada, 54% in Colorado. The inventory growth in the West and, of course, the South, the Sun Belt states, is really where inventory has been growing. There are two states which have fewer homes on the market now than a year ago. North Dakota, which has a very low base anyway, but also Connecticut. So Connecticut has just like 1% still fewer homes on the market than a year ago. The Connecticut markets are maybe the hottest markets in the country as a result. Why is that? The basic reason is that we've been moving from north to south for many years. We've been moving out of Wisconsin and Illinois and New York to Florida, Texas, Arizona. We've been moving north to south for many years. As it has gotten more expensive to move, not just mortgage rates, but insurance in Florida and Texas and taxes and the cost of appliances, as all of those have gotten more expensive over the few years, we have we've been moving less. So we're selling fewer homes in Connecticut and buying fewer homes in Florida. As a result, the inventory in Florida is building and the inventory in Connecticut is climbing. So we can zoom in here and we can see that these states, New York, Pennsylvania, New Jersey, Connecticut, Rhode Island, you can see really tight inventory here through the Midwest. Now, this is changing a little bit. So Ohio was in that before, and Ohio is now growing. Massachusetts inventory is now growing. So it's starting to build, starting to normalize a little bit. And my assumption had been that this year for 2025, we would be normalizing these more because we've had 3 years of really slow migration. And if what I'm watching for now is if the economy slows, what happens to this assumption? Does that mean we normalize, we get more sellers in Connecticut? Or does that mean fewer people are going to move? Does that exacerbate this dichotomy and make the Sun Belt states even purpler and the North even lighter? So we don't know yet. My basic assumption is that, a lot of these states were negative before. Now only really Connecticut remains as fewer homes on the market than a year ago. And many of these states have more inventory. In terms of absolute numbers, Texas has like 130,000 single family homes. Florida has 110,000. California, which is a much bigger state, still only has 50,000 single family homes unsold on the market. California has chronic shortage of inventory, and that has not changed, even though it is finally growing. And I'll show you some more implications of that in just a second. When we So now there's more homes on the market. There's more new listings, and they're staying on the market about 10% longer. So as a result, inventory continues to climb. So right now it is the 71 days on the market. Last year at this time, it was 64 days. A couple of years ago, it was 59. Then back during the pandemic, it was 40 days. Like, so you could see a dramatic change in how the market has shifted over the years. As a result, our forecast for inventory growth for the year is really revising up. And we revise this actually each week when the latest uh, inventory data comes in. The dotted line here is the projection by week for the rest of the year. And what we can see is that by the end of the year, assuming the current trends hold, we will end the year with more homes on the market than 2019. So that would be back to the old normal levels of available inventory. Each line here is a year, and I've just highlighted a few years. 2018, 2017, all those had more homes. It used to be common to have 1 million homes unsold on the market in the midsummer. 10 years ago that would be totally common. Now, and those are just single family homes. So this year, we'll be at 800,000, but by the end of the year, we will probably be above 2019. Now, this assumes that there's not a dramatic change in mortgage rates. So one scenario this year could be if economy slows notably, like unemployment ticks up, it could be that mortgage rates drop, and it could be that because homeowners have a lot of equity and there's still a lot of people employed, it could be that those lower rates continue to motivate home sellers. And so dramatically lower rates would decrease this forecast through the year. It would compress this purple line through the year. Uh, on the other hand, we've seen what happens when rates climb and how quickly, right? Rates have been higher for longer than expected this year. And so basically every week this year, inventory has come in higher than the forecast. And each week, almost every week, it's bumped this number, this assumption higher all year. So, but basically, we're looking at really another 25% growth in 2025. That has implications. So there's more selection. It's easier for buyers. It means there's less upward pressure on home prices than there has been in years. And we'll switch into the pricing numbers in just a second. So all those have implications for the market as we change, as the market goes through this shift, finally emerging out of that pandemic crisis shortage. For home sellers, there are people who are on the fence right now, and they're a little afraid. The way I explain it is that there is nothing in the data that says to me it gets suddenly easier for home sellers later in the year. There's nothing in the data that says inventory is tightening. There's nothing in the data that says demand is jumping. So in my view, I think there's a lot of evidence that says, you know what, if you're thinking about selling in 2025, earlier is better, uh, because there's nothing in the data that says a shift to make it easier for sellers is coming. Okay, let's shift to prices. So home prices, the median price of single family homes in the US, all the ones that went into contract this week, is $399,000. So these are the weekly pending home sales. These are ones that'll close, some in April, but mostly in May. And that's up just a fraction over last year. So, last year at this time, 394, 398, and we're at 399 right now. There's no signal in the data that suddenly we're going to bump over 400,000, but right around 400,000 for the next few weeks would be my expectation. The key takeaways here is that things volume is up. So nationally, there's nothing in the supply side of the equation that's going to drive home prices significantly higher. On the other hand, we can see a few things in the data here, and I've highlighted the 2022 line. So this green line for 22 in June and in September. In 22, by the time we got to June, mortgage rates were over 6%. And if you hadn't bought your home by May, you got out of the market. And so sales dropped dramatically. And so prices dropped dramatically in June. And then in September of that year, we saw rates jump again to 7.5. And that was a huge surprise. And buyers got spooked again. So prices dropped again in September of that year of 22. That led to the headlines of the spring 23 that were negative. Home prices have dropped year over year. But you could see it happening in the weekly pending home sales data in June and then again in September of 22. We don't have any of that happening right now. If market conditions, crazy conditions can happen, if mortgage rates were to jump to 7.5%, I'm looking for this pattern again that would drop prices quickly from their current levels. On the other hand, but we don't have it yet. So, and if we're lucky, rates dip down and keep prices supported. And we can see price support last year in September. We see this moment right here in September. This moment was when mortgage rates hit 6% last year. That came down from 7.5 down to 6. And that really spurred demand. And this reaction was a surprise to me at the time. So it wasn't just home sales, but actually home prices stayed elevated late in the year last year because this was when rates hit their lowest opportunity point for buyers. So there are buyers that came off the sidelines and took action, and that actually supported prices later in the year. So we've been talking about how mortgage rates, the threshold I've been looking for in 25 is about 6%. As we get closer to 6%, I would expect to see home sales kick up, notably, home prices to be supported if we get closer to 6%. That's been my expectation. We do now have the other variable of a weaker economy and things like fears about inflations and incomes. And so it'll be fascinating to see later in the year which of those wins out. It's a new variable that we haven't had, but that's what we're watching for. So you can really see the impact of when rates hit 6% last year and when they dropped to, hit 7.5 on the other side. As of right now, home prices are a little elevated over last year. And if we're lucky, they stay slightly elevated through the year. But really, we're looking at a flat year of home prices. Essentially no price gains is sort of where we're expecting to be at. You might not be surprised that because the inventory changes are so local, that home price changes are also local. So Texas and California and Georgia, South Carolina. So it's actually 4 states with negative home prices. If you were on the webinar in March, there were 8 states at that time. So some of these are moderating a little bit, and the ones that are around 0%, 1%, these are all essentially flat, and they can bounce up or down in either direction. I actually expect Colorado to turn negative maybe by the next month's webinar. That'll be interesting. Unless we get like lucky and rates drop, and then we saw what happens to prices there. So we can see a bunch of things. We can also see over here in the Northeast, home prices 10%, 7%, 10% in New Jersey, Connecticut. These are the states where inventory has been the tightest. We know that Massachusetts actually had a couple of had strong years. Inventory is now up about 30% year over year in Massachusetts, and home prices are moderated significantly. So if Connecticut, we can see, and I'll actually dive into a little bit more in Connecticut, can see if new listings start climbing a little bit in Connecticut, then we would expect this to maybe finally moderate a little bit. Um, so in a weakening market, we can imagine things like Louisiana, Oregon, Colorado, the Tennessee, North Carolina. These markets are the ones that are more likely to move negative next. Although it has moderated a little bit as we hit the spring. And a couple other things to keep in mind is that Texas and Florida especially really have had 2 years of inventory gains. A lot of the rest of the country is really only 1 year into the inventory gains. So they have more room to grow, like California. There's a lot more room for California inventory to grow before we get real negative home price pressures. Um, Here's another way to look at supply and demand. We have the sales price versus asking price. So we looked at the Altos HousingWire data and looked at home sales for March versus their last asking price. On the left side, we have a few markets that tend to sell above asking, and you'll notice the California markets, especially the Northern California markets, San Jose and San Francisco, have chronic shortage of inventory. There's always very few homes for sale. San Jose has 5 million people in the metro and has has like a fraction of the homes for sale in, say, Tampa. And so it's that very tight inventory per capita means that there's a lot more competition for every offer, for every listing, and and therefore it's over asking. But we can also see there's Connecticut, right? Connecticut is the tightest inventory place in the country, and as a result, buyers in Connecticut have been paying over asking. Boston has had a strong price year, has been very tight inventory, although that's changing. So Boston has an over asking price. On the other hand, you can see the Florida markets and the Texas markets. Texas markets are hard to get sales prices at. So there's some of the Texas markets I took out like Dallas. Dallas, the sales data we have for Dallas, it has Dallas at like 8% under asking as home sales data, and San Antonio also 8-9% under asking. But you could see where these are the tight inventory per capita, where we're still in like uh, real sellers mode. People in the Northeast who are like, man, we just need more inventory, and you can see exactly what's happening to buyers. So, setting people's expectation, knowing that this is what happens with sales price versus asking price, I think is a very compelling view. Okay, let's dive in. So to the leading indicators. So there are 35.6% of the homes on the market have taken price reductions, taken a price cut from the original list price. As in April, as I pointed out, that home sales were running ahead of last year, a little bit more demand. We can see that the price reductions basically plateaued in the 35s through April. A couple of things to really notice in this data. So each line is a year here. Last year at this time, this is when mortgage rates were spiking. And so in April of last year, went from 32 and a half to up to 33. So you could see this inflection point right here in April when mortgage rates spiked over 7%. You could see that inflection point in 22. Remember, I talked about how when home prices dropped in September of 22. Well, you can see it. If a house is on the market now and suddenly mortgage rates hit 7.5% and the offers don't come in, next Monday, I cut my price to simulate demand. And so we could see home prices this is the week that mortgage rates spiked. You could see it like almost to the week in the data. On the other hand, last year in the fall in 24, this is when rates hit their lowest level. And so you could see that that price reductions stayed lower. We were getting slightly more offers each week. And there's a real difference between 22 and 24. As of right now, there are more folks on the market with price reductions than have had in any April in like 15 years, 12 years maybe. You can see that, therefore, that means there is very little upward pressure on pricing. And that if this number turns higher, that's a signal of even fewer buyers, like buyers walking out. And one of my questions at the beginning was, can home sales stay up for more in 2025? And we'll see it here in the price reductions each week. And we can see it at the local level too. If price reductions are kicking up, that's a signal to sellers to say, like, look, do you want to be ahead of this curve or behind this curve? And there's nothing in the data that says that this is all getting better later in the year for sellers. So it's really, it says to me, like, it's, if you're thinking of selling in 25, sooner is better. I'm going to switch over to, well, let's do one thing on the forecast. So this is home prices. We can look at year over year changes. And the HousingWire forecast was still for 3.5% growth in home prices by the end of the year. We may have to adjust our forecast down because we can see that yearly change has really been dropping. And this is going to stay around 0% here for the next few weeks. If we get lucky and rates drop and we stimulate some demand, then that'll pick this up through the end of the year. But it's really looking like we're really looking like much closer to 0% home price gains for the year for 2025. So that's what we're looking at, the future of home prices. And finally, on prices, we should say that rents. Altos, we're tracking rent data every week, and the asking rent on single family homes is negative year over year in our sample. And so we're tracking, I think it's 100,000 or so single family homes for rent each week. And you can see that, rent appreciation back here was really high, and now it's actually negative year over year. And so this has implications, things for like, the future inflation numbers. Inflation numbers use rent in their data, and it's a very lagging indicator. So this implies to me that future readings on CPI are actually going to get a negative influence from rent data, and that's really been in the last month that's moved negative. But it's really pretty fascinating drop to me, to something to pay attention to. I'm going to switch over to Altos. If you haven't logged into the Altos system lately, I encourage you to do so. Or if you're new to Altos, you can go to altosresearch.com and go get a free account and start diving in. We've done some really cool data visualization stuff that you can now have immediate access to the data. You can get super quick deep dives. If you're sitting there with a client, you can say, let's look at price reductions and let's make listing price decisions. Like, do you want to be ahead of this curve or behind it? So that's just a quick view. If you haven't logged into your Altos account lately, you should go log in and give it a whirl. I'm going to switch shares now, and we're going to dive into some local markets. Okay. This is the Altos. I'm logged into Altos with my account. I have the advanced analytics tab open. I have a bunch of queries set up for stuff that I like to watch. So I have home prices ranked by all 50 states. We can see very quickly where, look at Rhode Island and how home prices have climbed in Rhode Island consistently since the pandemic, where in Tennessee, they're flat over the years. We were just talking about price reductions. Price reductions are a leading indicator of future home sales. And right now, the Florida markets are back at the top of the list. So most price reductions. This is the 50 highest price reduction markets in the country. And you'll notice that Sarasota at 57%, that's more than it has been. So this is like the weakest pricing these are all Southwest Florida markets right now. Here's Tampa. The first Western market to get in here is Phoenix. Phoenix is not quite as rough as it was 2.5 years ago as we emerged out of the pandemic, but is still obviously growing inventory, weaker demand, and that has implications for future sales prices. But the Florida markets are all up here driving further north. There's some Texas ones down. Here's Denver. So that's what I keep my eyes on. And this, I think, has been very fascinating to watch in the last few weeks. The Florida markets are showing the weakest pricing in the country. I've also got things like price per square foot. So, you can look at, we can see the New York markets, price per square foot has been continuing up for 3 years. But here's Dallas, weakness at the price per square foot level down. Philadelphia has been up in that time. But we can look and we can very quickly see here's San Antonio, right? And San Antonio almost looks like it hasn't found a bottom yet in price. Here's Austin, even quicker down pricing in price per square foot. All right, let's dive into some local markets. The first local market I want to look at today is Washington, D.C. We've had a ton of conversation about D.C. DC has obviously a weakening economy with a lot of government layoffs. And 2 months ago, there was all kinds of social media noise about, oh, the DC housing market is crashing. It's not crashing, but there is, when we look at the inventory numbers here, we absolutely can see inventory gains starting back when the government cuts started hitting. And so we now have reasonable inventory growth over a year prior. Things are still moving pretty quickly in DC at all price ranges. So 35 days at $2 million, 28 days at the low end. But inventory is building. And in fact, I opened up an advanced analytics query for DC Metro, and just to look at a year-over-year view of the new listings count. So each week, I've got the black line here is 2025, and you can see that in the DC Metro, we're close to 900 new listings per week, as opposed to 700 last year. So new listings volume is climbing in DC. It's not crazy because we could go back and look maybe at 2018 here and drop it in here and do a quick look if my internet's up and running. Here we go. And you could see back in 2018, tons more listings each week. 1,000, 1,300 rather than 800, but it's more. And so it's not crashing, but it is very obviously changing right now. And so you could sit with clients and do the same conversation compared to help them set their expectations. All right, let's look at Miami. Miami condos are obviously in a buyer's market scenario. We have inventory significantly up in the last few years, 33,000 condos. And you can also see in the Miami Metro, there are 100, you can see significantly lower. The middle price ranges are a little better, but the expensive ones over $1 million and the super cheap ones under 200,000 in the Metro, like these are where the slow time is. And we can look at the price decreased level for Miami condos. And I think that the important thing is when thinking about condos in Miami, if you think about this, so there are 33,000 condos available on the market, unsold in Miami. And there's only 49,000 single family homes available in all of California. Let's get my little, so I had Miami, let's look at the pending. So I've got the pending new count. So the weekly pending home sales in Miami for Miami condos, and look at 25 is still coming in significantly below 24. And if I look at where sales were last year, or 23 was even higher, 22. So you can really see how the Miami condo market has changed over the last couple of years. We've been talking about Connecticut a lot. So in Connecticut, so I have the whole state of Connecticut up here, still a strong seller's market. Here's the inventory curve, 5 years of inventory for Connecticut. You can see we're still slightly fewer homes than for sale than last year at this time. We could see that of the days on market, right, $500,000 in Connecticut is still, 2 weeks. Like these are homes that are going very quickly. Anything under $1 million is going very quickly, and even the high end is still under 50 days. And if you remember that in Miami condos is 129 days. And so, this is a significantly stronger market. And so the question I have, and I opened up the Connecticut new listings data, um, and let's take a look here. Um, what I'm interested in is, are the new listings starting to grow over last year? So even through March, new listings were below 24, and now they're slightly above. So we're going to watch this each week to see if new listings grow even more above last year. So in April, a little bit, I'm switching between, that's the 7-day number, and the 90-day has a smooth number. So it's a little easier to see the trend starting to grow over. And so if the Connecticut new listings continue to grow this year, that means that we finally will see some inventory growth. But even if you're selling in Connecticut, again, it's like it's a good time to sell. But there's no signal in the data that says that it's going to get better for sellers than it is right now. I have San Antonio open. The Texas markets obviously have been in the weakest markets in the country. We can see the price reductions data in San Antonio is at the highest level it's been in many years. 45% of the homes on the market in San Antonio have had price cuts. We can see the inventory is well above where it was when we went into the pandemic. We can see that slowness is pretty much across the board in San Antonio. I am watching in San Antonio to see if, for example, price reductions get close to 50%. It does the opportunity in San Antonio, if the economy weakens, if mortgage rates rise, we could see places like that, like these, and immigration is way down, that can really impact a market like San Antonio. I'm going to do a couple others real quick. Here's the state of Colorado. I mentioned that Colorado might turn negative in home prices. You can see the inventory levels in Colorado are higher than they were back in 2019. More homes unsold on the market in 2019. And you can see that, let's look at price reductions here, were significantly higher than they were in 22. 22 got way up here to over 50%. And we're not there yet. So 36% of the homes on the market in Colorado have taken price cuts. And so it is a mildly weaker indication of future home sales prices. As I mentioned, if you saw the map, Colorado is currently at just a fraction of a percent. Home prices up just a fraction of a percent over last year. And that looks like it could go negative, especially if that inventory continues to climb. And one last one, I got Asheville, North Carolina up. North Carolina had a really fascinating year, had hurricanes. It's been a strong inbound migration, not immigration, but migration state for a bunch of years. But here's what I'm noticing in Asheville. Look at inventory is really climbing in Asheville over the previous weeks. So there may be migration things slowing. This may be homes that were delayed last year with hurricanes that are now coming on the market. There may be insurance cost things where people are like, wow, it's now more expensive to live here. So those are coming on. Asheville still has fewer homes than back here before the pandemic. So we're not quite back to normal, but you can imagine by the end of the year with this shape of this curve that we will get there, that Asheville will be above the normal, the old normal levels. Uh, okay, that's all the local time. If I didn't get to your local market, you can go to Altos Research. You can enter your zip code. You can get a free report. You can book a demo with our team to talk about the local market with someone to understand what's happening in your local market, how to use that to help buyers and sellers right now. So if you haven't already done so, I highly encourage you to go get a free report, connect with us so we can dive in and you can start communicating today. All right, that's all the time we have for today, folks. I really appreciate you being with us. I'll stick around and we'll make sure that we answer all the questions in the chat. It's a crazy time in the market, so stay tuned to the weekly data so that we know exactly what's happening. Thanks, everybody.